Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thanks very much for tuning into my video today, and please don't forget to like this video and subscribe to my channel. That will be amazing. So in today's video, we are going to be talking about what happened in the markets last week, and I'm going to be going over a bit more detail about our portfolio overall as a whole. So I'll be really honest to start things off, and I'll say that the last week and actually really the last month has been a bit difficult overall for the stock market and the crypto market, and really, to be honest with you, any asset class with the exception of possibly oil. And it has been no different really for our portfolio. It's been very difficult in January overall. And I've tried my best to hedge as much as I possibly could, and also to do some short-term positions in order to make profits. And also I've used some of the opportunities in the dips to further increase our position in some key stocks that I really like. And looking at hindsight, I probably could have hedged the portfolio a little bit more, but I didn't expect it to go as deep as it has done during the month. So I will keep agile, and I'll make sure that I keep hedges on where's required, but still make sure that we are primed for future growth. So thanks very much for staying patient with our portfolio. I really appreciate all of you. And I think it's important to take a long-term approach and not to worry too much from month to month. And I still have a positive outlook overall for the whole of 2022. Although these times are particularly volatile because of what is happening in the Fed, which I'll explain a little bit more. As we move on to the weekly global market update, and I will start off with the US. And the US was a big roller coaster last week, and it was really dominated by the Federal Reserve meeting on Tuesday and Wednesday. We saw lots of dips earlier on in the week, and it was a very volatile time where often the market would start off ahead, and then by the second half of the market, then we would see a big pullback in stock prices. And this kind of continued for much of the week. However, late on in the week, we did have a good recovery. So the S&P 500 did actually finish the week slightly above at 0.6%, and the Nasdaq was roughly flat overall for the week. But it was on the back of several tough weeks overall for the Nasdaq. And as I said, the week was dominated by that Fed meeting on Tuesday and Wednesday. And it really started off with Jerome Powell and his speech, in which he said that there was going to be no more Federal Reserve interest rate hikes before March. So obviously that was a big concern, that they would do a interest rate hike before March. And the other point which was said in the meeting was that there was a lot of concerns previously that there was going to be more than the scheduled 3 rate hikes that were outlined last November by the Fed. However, they said that they haven't made up a decision yet exactly how many rate hikes that they will have, and they are going to stay nimble and agile depending on what happens in the markets. They also said that they plan to reduce and shrink the balance sheet. Obviously, the US has a large debt, and they are talking about that. Obviously, at the times of the pandemic, they heavily inflated the balance sheet, and now they are looking to bring that down. But it was actually said in a very nondescript way, and it wasn't actually said exactly how they were going to do that and in what timing. So it's something that is really obvious now, that they are looking to continue with quantitative tightening instead of the previous quantitative easing that we had before. So the markets reacted again very up and down, because there was no particular clarity that was provided. Although they didn't say they were going to increase rates straight away, they did say that they were open to see what happened overall in the economy, and it left that kind of ambiguity. It's tough in the stock market because sometimes the stock market reacts worse to uncertainty than it does to bad news in general. And I think generally investors didn't know which way to take this this Fed Reserve meeting that happened, and it didn't provide a lot of clarity, which would have been much more healthy. However, I'm not particularly that concerned about what's happening in terms of quantitative tightening. It's happened before throughout history, and actually in periods, if we look at the data, in periods after quantitative tightening starts and we start to see interest rate hikes, the stock market has still averaged about 5% per year after those interest rate hikes have been put in the history. So I think there's a lot to be positive about, and I think that these corrections are quite normal really, especially after we've seen really strong 2020 and 2021, obviously with a lot of stimulus. And yeah, it's quite often that you have to pay back some of this debt. So I think the strong companies will survive. And I think that there will be some difficulties with some of the companies with weaker balance sheets or less cash flow. However, I think that the markets generally will be just fine. As I mentioned about the volatility was particularly high last week because, as I said, the investors didn't know exactly how to take this Federal Reserve meeting announcements. So the VIX, which measures volatility overall in the stock market, was actually at its highest point since the start of the pandemic. We all remember the start of the pandemic in March 2020 and April 2020. So the VIX actually got to very similar levels to that start of that pandemic last week. So we hope that that volatility starts to die down, but I would expect it to remain probably over the next couple of weeks while the market picks a direction. We also saw oil rise to $90 per barrel, and the oil price is becoming very high. And the reason why it's got to $90 per barrel is there is a lot of concerns and worries around the Ukraine-Russia relations that are happening at the moment and the conflict that's occurring. And this is causing the oil prices to rise quite sharply because Russia is the second largest oil producer in the world. We also saw natural gas prices rise very high as well because Russia produce a lot of natural gas, and there has been some threats that they wouldn't supply to Europe and the United States, for example, if they were to impose further sanctions. So I am expecting oil prices to continue to rise. I think with the demand for oil coming back on after COVID and especially the Omicron variant, they're not increasing the supply of oil that much, and the OPEC Council has very kind of strict limits. I think that's another thing. And also we have this rising inflation, which obviously commodities such as oil is going up against the dollar as well. And with these countries, which are obviously such as Russia, and the threat of a reduced oil supply, I think it's very likely that oil will increase to over $100 a barrel in the next couple of months. And I have positioned our portfolio accordingly with long positions in Chevron as well as Canadian Natural Resources Company. However, we did see some economic data from the economy in the US, in which the PMI was at about 50.8, which is the lowest PMI figure since for 18 months. And I guess the main reason for this is they had a record number of Omicron cases in the US over the last kind of month or so. And this caused a lot of pressures overall on the services sector. I think the manufacturing was still pretty good, but the service sector was really affected by Omicron. However, I expect this to be kind of short term, as a lot of the restrictions have been lifted and people are going back to relative normality after Omicron, because it hasn't been that serious. As we move on to Europe now, and again for the fourth consecutive week, European indices were weak, with most of the major European indices down overall for the week. And we also saw obviously a lot of cases of the Omicron variant throughout Europe. However, we are starting to see some of these restrictions being lifted in Europe, and following on from the UK and also from Ireland, we are seeing countries such as Denmark, which have agreed from the 1st of February that they are going to remove all restrictions. There's also talk that Norway, Sweden, and also Finland are planning to remove these restrictions as well over the next week or two. So we are seeing a trend that these countries are starting to remove these restrictions and trying to go back to normality, which I think will be overall very good for the Eurozone and the European area. We also had a very similar story on the economic readings in Europe, with the PMI at 52.4. And again, this was to do with the services sector being particularly weak. The manufacturing sector was produced some good results. However, again, this is to do with Omicron. There was a massive surge in cases in Europe, even more than other areas around the world. And this took its toll overall on the economy in January. But again, I expect this to improve over time. Germany's GDP contracted by 0.7% in the fourth quarter of 2021. Again, a lot to do with Omicron. And we also saw data released from other countries as well, such as France and Spain. And France actually showed that GDP had grown by 0.7% over the last 3 months. And Spain had also grown by about 2%. Overall, I'm expecting Europe to do quite well, and that's why I have quite a few European stocks in our portfolio. It's been very obvious that they've been quite hard hit during the Omicron variant over the last couple of months. However, I expect a good bounce back as the economy starts to purr again, and we start to see more people buying goods and services, and many people and restrictions being lifted. So I think it's very positive overall for the next kind of 3 to 6 months in Europe. As we move on to China now, and last week Chinese stocks continued to slump, and this was for a number of different reasons. I think one of the first reasons was the fact that it was coming up to Lunar New Year. Oh, and by the way, Happy New Year, Lunar New Year to all of those that celebrate it. I think it was an opportunity for a lot of the hedge fund managers and retail participants to rebalance their portfolios and sell off some of their shorter term positions. And I think the other reason was to do with the Fed meeting in the US. And there was a lot of concerns that they were going to increase the number of hikes in terms of the interest rates. And this does affect China, because China does borrow a lot of money from markets in the US. And this makes, if they increase the interest rates and the interest rates go up faster, this increases the overall borrowing costs for Chinese companies. So I think those were some of the main reasons why the Chinese stock market was down last week. We also saw Chinese industrial firms slow to the lowest levels since 1.5 years. And I think a lot of that has to do with the Chinese real estate sector, which, as we know, has been in a lot of trouble over the last year or so. And we saw further news from Evergrande, and Evergrande have said that they are going to prepare a proposal for debt restructuring within the next 6 months. And there was a lot of concern there from especially offshore bondholders about exactly how they're going to pay back the debt overall to the foreign companies. Another piece of news about Evergrande was that Oaktree Capital, which is a US investment fund, has actually seized one of its largest residential projects in Shanghai as they have defaulted overall on their debt. We talked about Apple earlier on in this video that they did really great blockbuster results for the last quarter. However, they also announced that in China, they had become the #1 smartphone company in China, and they have taken over from Huawei. And this is the first time in 6 years they have been top of the tree. And a lot of the reasons to do with this is that Huawei have received a lot of different sanctions, and this has slowed their growth around the world, but also in China as well, which has been very good overall for Apple. There was also economic data released from China, which said that fiscal revenue had grown by 10.7% in 2021 compared with 2020. And this is because there was a lot of economic recovery overall in 2021 in China. If we remember that in 2020, the COVID-19 pandemic started a lot earlier in China and actually originated from China. So they had a lot of economic effects in 2020. And it's been a brighter 2021, albeit still recovering. And there is a lot of hope that this additional fiscal revenue can be provided to the different provinces around China in order to increase their balance sheets. As we move on to crypto now, and last week generally was a bit up and down again for the crypto markets. However, we did see an increase in the Bitcoin price, which went up by about 4.5%, and Bitcoin's sitting at about 37,500. And that's an improvement from last week. And I think we saw a lot of buyers around that kind of $33,000 area, and there was a lot of data that was actually released that there was a lot of orders that came from Coinbase around that $33,000 area. So that is a really good sign, and it shows there's a lot of buyers. I am getting more and more confident that we are starting to reach a bottom in terms of the Bitcoin price that we've seen over the last couple of months. Bitcoin has been heavily correlated with the Nasdaq, and people often say, well, why is Bitcoin correlated with the Nasdaq? It's supposed to be a flight to safety asset, and it's supposed to not have correlation with the overall markets. And the answer to that is Bitcoin does change a lot, whether it is correlated to the markets or not. And especially during times of panic and extreme fear, Bitcoin then often correlates to the higher risk on assets such as growth stocks. And that's exactly what we've seen with the Fed and what happened with the Fed. And those fears and those anxieties around interest rate hikes and monetary tightening. I expect that to decouple over time, but it may persist for a period until there is some level of certainty on exactly when they are going to increase those interest rates and by how much and how many times next year. But that clarity will come overall in time. We also saw a lot of good positive on-chain data coming from Bitcoin. And one of the key areas of interest for me was the fact that whales buying Bitcoin has started to increase over the last week or two. And what we actually saw was whales buying Bitcoin all the way up until about October. And then the Bitcoin price hit its all-time high in November, and whales started to sell off. And what you see is that generally with whales and large long-term Bitcoin holders is that they tend to buy when the prices are low and then start to sell off and reduce those positions when Bitcoin starts to get near its all-time high. And those amount of large wallets and people buying Bitcoin had decreased all the way until just last week or two. So we are now starting to see that increase. And I think that really shows that with larger Bitcoin holders, that they are much less likely to sell. And I think we have phased out a lot of the retail investors who were heavy speculators and who were in loss, and they wanted to sell those positions, and they've been happily scooped up by the long-term Bitcoin holders. So that's a good sign in the market. The other good sign in the market as well is that there have been outflows overall from Bitcoin exchanges. And this is generally seen as a very positive on-chain metric, because as people transfer their Bitcoin holdings to their own wallets, it is much less likely that they are going to sell their Bitcoin and other cryptocurrencies than if they have those or have moved those onto exchanges with the idea in order to sell those. So that is another positive area. If we also look at on-chain data as well, in Bitcoin, there is two types of Bitcoin investor. You have your short-term momentum traders who try to get in on a Bitcoin price, and then as it increases, they will sell off that position. And the second type is kind of your long-term hodlers. And if we look at on-chain metrics, the short-term momentum traders, and that's the people that have bought Bitcoin over the last couple of months, the average price is about 41,500. So this will be a key area for Bitcoin to break over to the positive side, and we should also get some more momentum traders as that surpasses the area. It may take a couple of attempts to break that key area of support. There was also some positive news coming from Arizona in the US, and there was a bill which was submitted which tried to make Bitcoin legal tender in the state of Arizona in order to be able to pay such things as taxes in Bitcoin. This would be another key benchmark, and I think if we do see this bill pass for Arizona, it is quite likely to be spread to other areas around the US, as there are a lot of crypto-friendly states in the US. As I mentioned in my posts over the last couple of weeks, I think about 2 weeks ago, there was a lot of concern around the Central Bank of Russia, talking that they recommended that Russia ban Bitcoin mining and also crypto trading. However, it was said by the big boss man, Vladimir Putin in Russia, that they did not plan to ban Bitcoin, and instead they wanted to be able to regulate the Bitcoin and crypto industry, which is totally normal. So basically, Vladimir Putin put a stop to that thinking by the central bank that they were going to ban Bitcoin. And it didn't really make much sense to me when I heard that a couple of weeks ago, because the Bitcoin mining industry is growing from strength to strength last year, and actually we saw Bitcoin mining revenue at about $5.5 billion in 2021. So it makes sense that Russia want to have a piece of that pie, and they do not want to miss out. However, we did see another Bitcoin spot ETF get rejected last week for the Fidelity Bitcoin ETF, and not much of a surprise. I think the precedent was set a couple of months ago when the Van Eck spot ETF wasn't approved, and I don't expect the applications that are in process at the moment to get approved. I think the best chance that we have is from Grayscale, because they have a lot of experience in managing large amounts of money in Bitcoin. However, I don't think it will happen in the short-term future. However, I do think it's going to become too big of a pressure for the 𝘃𝗶𝗃 to ignore, and I'm expecting in the long term a Bitcoin spot ETF to be approved, especially as we've seen these ETFs approved in countries in competition with the US, such as Canada. Last week, it was also announced that the Stellar Foundation strongly plan to launch smart contracts in 2022. And this would be very good overall for the entire ecosystem, and especially the Stellar Lumens token, the XLM, which I expect to do pretty well in 2022, and which we have in our portfolio. I just want to thank all my copiers for their patience over the last couple of months. And I know it's been a difficult time overall for the markets and for our portfolio. And I know that there may be times where you might be a little bit anxious about your overall invested money in the markets. And a lot of you might be new copiers, or you might be completely new to investing. And you might have only experienced times where things are going down. However, what you need to know is, from my experience and from the experience of people that have invested for a long time, these types of periods are not uncommon. And it's very important that you kind of keep that long-term perspective. I mean, in the long run, markets tend to provide really good returns. And if we look at the S&P 500, for example, since its inception in 1928, markets have gone up over 10% on average per year. And over the last kind of 10 years, we've actually seen that at about 15% per year. But you do get some of these sticky periods, especially in the economy, especially when you have a lot of volatility and a lot of things that are happening in the market at the same time, such as interest rates, inflation, the pandemic. However, overall, the company results are really strong. And that gives me a lot of positivity overall in the markets, that especially with the stocks that I've chosen, that I think that they will do really well in the long run. And I also have a very positive outlook on crypto. So please continue to stay patient. Think of your investment in the long term, and actually take this as a good opportunity to dollar cost average into your copy, because it does make a difference in the short term, especially if you lower your average buy-in price. And I think now could be a very good time to dollar cost average into your positions. Thank you very much for listening to my video today, and don't forget to join my Discord group, where we have regular conversations with our amazing bees community around all investment subjects, and we have a hell of a lot of fun. So join on the invitation below. And until then, have a good week ahead.